Across history, empires with vast wealth and military power have collapsed not from sudden attack, but from the slow erosion of trust in their financial systems. Rome, once unchallenged, suffered decades of currency debasement, crushing debt, and fiscal mismanagement that quietly undermined its foundations. By the 3rd century, Roman coinage had lost over 80% of its silver content, fueling runaway inflation and eroding public confidence. Citizens faced soaring prices while the state struggled to fund its armies, exposing a lethal link between fiscal policy and societal stability. The empire's debt was not only financial, but also political, as emperors borrowed heavily to secure loyalty from generals and bureaucrats. This spending temporarily postponed crises, but it deepened structural weaknesses that would later accelerate Rome's decline. By the late 3rd century, Rome faced simultaneous pressures: external invasions, internal revolts, and a currency so devalued that basic wages could no longer sustain soldiers or workers. This convergence of military, social, and financial stress created a warning signal that no single reform could easily fix. The paradox of Rome was clear: immense power on paper, but systemic fragility beneath the surface. Even as the empire expanded, its financial foundations weakened, showing how wealth alone cannot prevent collapse when debt and inflation spiral. Fast forward to today, and the modern global economy faces a similar paradox. Record-high national debts coexist with unprecedented monetary expansion. While the United States wields unmatched economic influence, warning signs, rising deficits, inflation pressures, and complex financial dependencies mirror historical patterns. In 2025, U.S. federal debt surpassed $33 trillion, with annual deficits consistently exceeding $1.5 trillion, highlighting the tension between spending promises and revenue realities. Analysts warn that, like Rome, a delayed recognition of fiscal limits can transform manageable debt into systemic risk. Global investors now navigate a delicate balance between trust in the U.S. dollar and growing concerns about long-term fiscal sustainability. Any erosion of confidence could trigger cascading effects across credit markets, trade, and currency stability worldwide. History shows that financial crises often arrive not with sudden shocks, but through years of slow, compounding imbalances. Rome's experience reminds us that empires can appear invincible, while their economic foundations quietly deteriorate. The lesson is stark. Enormous resources and global influence do not immunize a nation from the consequences of fiscal mismanagement. Early warning signals, rising debt, inflationary pressures, and currency stress are critical indicators that even superpowers cannot ignore. Excessive sovereign debt consistently creates pressure on both domestic and international financial systems, forcing governments to prioritize short-term liquidity over long-term stability. As deficits grow, nations often rely on central banks to monetize debt, which introduces inflationary pressures that erode real economic value. Credit expansion fuels temporary growth, yet it also creates artificial asset bubbles, mispricing risk across markets. When these bubbles burst, the resulting financial panic exposes the underlying fragility of the system, amplifying economic shocks. Inflation functions as a hidden tax on citizens, gradually transferring wealth from holders of cash to borrowers, including the state itself. Rome and modern economies share this mechanism, where devalued currency undermines purchasing power and public trust. Persistent fiscal deficits lead to rising interest obligations, which consume increasingly larger portions of government revenue. This creates a feedback loop where borrowing is necessary to service existing debt, gradually reducing policy flexibility. Currency devaluation is a common symptom of chronic debt mismanagement, signaling that market confidence is eroding. Historical examples show that even empires with abundant resources cannot sustain prolonged devaluation without social and political consequences. Banking systems amplify these patterns by providing leverage and credit expansion that magnifies both growth and risk. When confidence falters, bank runs or liquidity crises can spread rapidly, creating systemic instability. Monetary policy often lags behind economic reality, creating a dangerous disconnect between market conditions and official interventions. Delayed responses to inflation or debt accumulation can make eventual correction far more painful. Wars and military spending historically accelerate these economic patterns, as governments borrow to finance campaigns, often without sufficient taxation to cover costs. Rome, France under Louis XIV, and Germany during World War I all illustrate this recurring stressor. Debt to GDP ratios provide a measurable warning signal. Ratios above certain thresholds historically correlate with higher probability of financial crises. While thresholds vary, the principle is consistent. Excessive leverage strains a nation's ability to respond to shocks. Financial innovation can temporarily obscure risk, as complex instruments spread exposure across markets. However, when underlying debt quality deteriorates, innovation fails to protect against cascading defaults and systemic collapse. Inflation expectations become self-fulfilling in such environments, as businesses and consumers anticipate rising prices and adjust behavior accordingly. This behavioral response accelerates the erosion of real incomes and savings, compounding social strain. Sovereign credit ratings act as both signal and constraint. Downgrades increase borrowing costs and limit policy options. Countries with weakened credibility face a more rapid slide into instability as confidence diminishes. Historically, the feedback loop of debt, inflation, and currency stress has triggered crises in diverse contexts, from 17th century Spain to 1920s Weimar Germany. Despite differences in institutions and technology, the fundamental pattern repeats. Central banks' interventions, such as lowering interest rates or quantitative easing, can delay but not prevent eventual adjustment. These tools shift the burden of correction to future periods, often magnifying long-term instability. Trade imbalances interact with domestic debt cycles, as nations reliant on foreign capital can face sudden stops when external confidence erodes. Currency depreciation, capital flight, and rising interest costs then compound domestic fiscal pressures. Political pressures frequently distort economic decision-making, with leaders prioritizing immediate popularity over sustainable fiscal policies. Rome's emperors and modern democracies alike demonstrate the human element in perpetuating debt cycles. Debt restructuring historically serves as a last resort mechanism, but it often occurs under extreme economic and social distress. The process can restore solvency, but also imposes long-term reputational and financial costs. Population demographics amplify or mitigate these cycles. Aging societies face higher entitlement spending, while younger populations can generate temporary fiscal relief. Misalignments between demographic trends and debt obligations accelerate structural imbalance. Transparency and reliable data are critical in monitoring these patterns. Yet governments often obscure real fiscal conditions to maintain confidence. Delays in revealing true debt burdens historically precede sharper crises, as seen in pre-collapse Rome and modern emerging markets. Ultimately, the recurring economic pattern is a slow accumulation of stress across debt, currency, and credit systems, culminating in crisis when thresholds of confidence are breached. Recognition of these patterns offers the clearest opportunity to prevent collapse, even in complex modern economies. Rome's financial decline accelerated during the 3rd century CE, a period historians call the crisis of the 3rd century, when political instability combined with fiscal stress. Between 235 and 284 CE, over 20 emperors ruled in rapid succession, each increasing spending to secure loyalty, often through debt or coinage debasement. Military expenditure accounted for nearly half of the Roman state budget, as constant threats along the Rhine and Danube frontiers demanded large armies. Emperors increasingly relied on short-term loans and confiscations, creating a fiscal cycle that could not sustain long-term obligations. Taxation failed to keep pace with rising costs, and tax collection became increasingly localized, reducing the central government's revenue control. Landowners in provinces often evaded payments, shifting the burden to urban populations and further eroding economic stability. By 270 CE, food prices had risen by an estimated 300%, a rate historians link directly to debased coinage and disrupted supply chains. Urban riots and peasant revolts emerged as predictable consequences of eroded purchasing power and fiscal pressure. Emperors attempted temporary fixes, such as Diocletian's edict on maximum prices in 301 CE, which sought to cap inflation artificially. These measures failed, as enforcement was impossible across the vast empire and black markets flourished. Rome's banking and lending systems were rudimentary but significant, with wealthy families acting as creditors to the state and military suppliers. Defaults and payment delays created cascading economic stress, weakening commercial activity and reducing overall liquidity. Beyond Rome, the Spanish Empire in the 17th century offers another clear example of debt-driven collapse. By 1627, Spain's public debt reached over 60 million ducats, while revenue streams were insufficient to cover interest payments, leading to repeated defaults. Spain's reliance on silver imports from the Americas created a temporary illusion of solvency, but inflation followed as the influx of precious metals devalued currency. Domestic production suffered, while international lenders demanded higher rates, deepening fiscal strain. The Weimar Republic provides a modern parallel, as Germany's post-World War I reparations created unsustainable debt pressures. Between 1921 and 1923, the mark lost 99% of its value, with monthly inflation rates exceeding 50%, leading to social upheaval and political extremism. Weimar Germany's central bank printed money to cover deficits and reparations, illustrating the same debt, inflation, currency collapse cycle seen in Rome. Public confidence evaporated as wages and savings became virtually worthless, destabilizing both commerce and governance. Argentina's 2001 default exemplifies how modern sovereign debt crises follow similar mechanics despite advanced financial systems. By December 2001, Argentina's debt exceeded $132 billion, roughly 50% of GDP, and the government froze bank accounts, triggering widespread panic. In Argentina, reliance on dollar-pegged currency policies magnified fiscal inflexibility, mirroring Rome's reliance on silver as a value anchor. Once confidence eroded, capital flight, inflation, and social unrest accelerated the collapse, forcing painful restructuring. Rome also suffered from demographic pressures, as declining rural populations reduced tax revenue while military demands increased. Similarly, modern crises often interact with demographic trends, illustrating the universality of structural pressures across eras. The 3rd century empire also faced logistical constraints. Transport of grain from Egypt became more difficult as infrastructure deteriorated. This compounded economic stress, showing how administrative inefficiencies amplify financial fragility. Military inflation, paying soldiers in debased coin, was not only a fiscal problem but a social one. Armies could lose morale or loyalty when their pay failed to maintain living standards, creating further political instability. Historical case studies consistently show that currency debasement, debt accumulation, and inflation form a triad that precedes systemic crises. Rome, Spain, Weimar Germany, and Argentina all demonstrate how this triad triggers wider social and political consequences. By the mid-3rd century, Rome's provinces increasingly resisted imperial taxation, effectively defaulting at the local level. This mirrors modern sovereign debt situations where regions or institutions cannot honor obligations, creating cascading risk. Debt rollovers, a common modern solution, have historical analogs. Rome occasionally rolled obligations by issuing new coinage or promising future land grants. While temporarily effective, these measures delayed, rather than solved, structural imbalances. Spain's repeated defaults in the 16th and 17th centuries illustrate the danger of over-reliance on foreign credit. Each default increased borrowing costs for the next cycle, trapping the nation in long-term financial stress. Weimar Germany's hyperinflation also demonstrates the social impact of monetary collapse, with bartering replacing currency in everyday transactions. Rome similarly experienced the erosion of trust, where tax collection and market exchange increasingly relied on in-kind goods rather than coins. In Argentina, the collapse of the banking system mirrored ancient patterns, with public confidence acting as the ultimate determinant of economic stability. Once trust disappeared, even substantial reserves were insufficient to stabilize the system. Rome's fall was gradual, but the warning signals, debt accumulation, inflation, currency debasement, and social unrest, were evident to contemporary observers. These patterns provide an analytical framework to understand the inevitability of stress under poor fiscal management. Across these examples, one recurring theme emerges: temporary fixes, whether price controls, monetary expansion, or foreign borrowing, can delay but not prevent collapse. Structural imbalances accumulate silently, and eventual correction occurs under duress. By examining these case studies, we see the continuity of economic patterns across centuries, reinforcing that systemic financial stress is rarely unique to a single period or culture. Rome's experience was not an anomaly. It was a prototype of recurring economic mechanisms. Modern economies often mask these stresses through complex financial instruments, but the underlying pattern remains the same. Debt growth, inflationary pressure, and currency instability create predictable vulnerability. Recognition of these historical precedents is crucial for anticipating contemporary risk. Rome's fiscal failures demonstrate how interconnected economic, military, and political factors amplify systemic risk. Even advanced administrative systems could not overcome the structural challenges posed by debt, inflation, and debasement, offering a cautionary lesson for modern policymakers. Spain, Germany, and Argentina each show that crises manifest not solely due to external shocks, but from internal imbalances that compound over decades. These cases provide concrete evidence that debt cycles and monetary mismanagement are universally consequential. The historical record also emphasizes timing. Crises often appear sudden, but develop over decades of accumulated imbalances. Policymakers who fail to identify early warning signs face far higher costs when collapse arrives. Finally, historical analysis underscores a central insight. Patterns repeat, and ignoring them invites repetition of mistakes. Rome fell slowly, but its trajectory provides a clear blueprint for understanding how modern superpowers might confront similar systemic pressures. The United States today carries a total federal debt exceeding $33 trillion, a figure larger than the combined GDP of most industrialized nations. This level of indebtedness, while manageable in the short term, raises long-term concerns about fiscal sustainability and interest obligations. Annual budget deficits consistently exceed $1.5 trillion, reflecting the structural gap between government spending and revenue collection. Without corrective measures, these deficits contribute to a slow accumulation of systemic financial risk. The Federal Reserve plays a central role in mitigating short-term stress through monetary policy, including interest rate adjustments and quantitative easing. These interventions support liquidity, but also expand the money supply, creating inflationary pressures that echo historical patterns. Since 2020, quantitative easing programs have added trillions of dollars to the U.S. financial system, aiming to stabilize markets after global crises. While effective in the short term, these programs raise questions about long-term currency value and debt sustainability. Interest payments on the debt now consume over 15% of federal revenue, constraining the government's ability to fund essential services without additional borrowing. This mirrors historical patterns where debt servicing dominates fiscal capacity, limiting policy flexibility. Social programs and entitlement obligations, including Social Security and Medicare, are projected to grow substantially over the next 2 decades. Demographic trends intensify fiscal pressure, much like population, and military demands strained Rome's economy. Inflation, which remained subdued for decades, has reemerged as a critical concern in 2022-2025, with CPI increases averaging over 6% annually. Rising prices erode purchasing power and can trigger the same feedback loops observed in historical collapses. U.S. reliance on the dollar as the global reserve currency provides temporary insulation from external pressure. However, growing interest in alternative reserves, such as the euro, yuan, or cryptocurrencies, signals potential vulnerability in the long term. The national debt to GDP ratio now exceeds 120%, a level historically associated with slower economic growth and higher default risk. Economists warn that continued accumulation without fiscal adjustment could accelerate structural instability. Federal borrowing relies heavily on foreign investors, with nations like China and Japan holding significant portions of Treasury securities. Any shift in confidence among these creditors could rapidly increase borrowing costs, paralleling historical reliance on external financing. Modern banking systems magnify economic patterns by creating leverage that multiplies both growth and risk. Banks' exposure to government securities and derivatives mirrors the ancient pattern where financial intermediaries amplify systemic stress. Asset bubbles, particularly in housing and equities, illustrate the dangers of credit expansion divorced from real economic productivity. Historical analogs, from Rome to Weimar Germany, show how these bubbles eventually destabilize markets when confidence falters. Debt-financed stimulus programs temporarily support consumption and growth, but they often postpone structural correction. The delayed recognition of imbalances can make eventual adjustments more severe, a lesson drawn repeatedly from historical crises. U.S. monetary policy also faces constraints from global capital flows, as lower interest rates encourage borrowing but can spur capital flight if confidence wanes. This creates a delicate balancing act, reminiscent of historical empires managing debt and currency valuation simultaneously. Trade deficits compound the pattern, with the U.S. importing more than it exports, financed by borrowing and dollar inflows. Persistent imbalances amplify vulnerability, as the nation relies on continued foreign confidence to sustain spending. Corporate and consumer debt levels have surged alongside government obligations, creating interconnected risk across the private and public sectors. A downturn in one segment can propagate rapidly, reflecting the systemic feedback loops observed in historical collapses. The COVID-19 pandemic accelerated existing fiscal and monetary trends, demonstrating how crises exacerbate pre-existing structural vulnerabilities. Emergency spending and liquidity injections temporarily stabilized the economy, but added to long-term debt accumulation. Emerging technologies and financial instruments, while innovative, can obscure true levels of risk, creating illusions of stability. Complex derivatives, ETFs, and algorithmic trading increase systemic exposure, making detection of imbalances more difficult than in historical analogs. Public perception and confidence remain central to stability, as trust in government fiscal management underpins currency value. Any erosion of confidence can trigger accelerated cycles of capital withdrawal, inflation, and liquidity crises. Ultimately, the modern U.S. economy displays the same repeating patterns identified in historical case studies: debt accumulation, inflationary pressures, currency dependency, and systemic interconnectivity. Recognition of these parallels is essential for evaluating future risk and understanding the vulnerabilities of even the world's largest economy. If current debt accumulation and fiscal policies continue unchecked, the United States could face higher inflation rates, eroding real incomes and savings across society. Rising interest payments would consume a growing share of government revenue, reducing funds available for infrastructure, defense, and social programs. Banking and financial markets could experience increased volatility, as elevated debt levels and leveraged positions magnify systemic risk. A sudden loss of confidence could trigger liquidity crises, asset sell-offs, and sharp corrections similar to historical collapses. Persistent deficits may force future governments to implement austerity measures, potentially triggering social unrest and political polarization. Historical patterns demonstrate that delayed correction often comes at a higher economic and social cost. Currency stability could face pressure if inflation accelerates or if confidence in fiscal management erodes. While the US dollar currently dominates global reserves, competition from other currencies or digital alternatives could reduce its privileged status over time. Global trade could be disrupted as foreign creditors reassess risk exposure, potentially demanding higher interest rates or reducing dollar-denominated investments. Such shifts would increase borrowing costs and place additional stress on public finances. Asset bubbles, including real estate and equity markets, remain vulnerable under prolonged low interest rate policies and high debt. A sudden adjustment in valuations could propagate losses through both institutional and retail investors, amplifying economic stress. Geopolitical risks intersect with fiscal vulnerability, as international conflicts or sanctions can exacerbate financial imbalances. History shows that economic fragility often magnifies the consequences of external